A lessee and a lessor entered into an 8-year lease, where the lessee leased 10 vehicles for an annual payment of 1 million, payable at year ends. At the commencement date, the lessee's incremental borrowing rate was 6%. At the beginning of the 4th year, both the lessee and lessor signed an amendment to the original lease that added the right to use 5 more vehicles, and decreased the contractual lease term to 6 years. The lease payment for the additional vehicles was $350,000, payable annually at year ends for the remaining lease term. These additional 5 vehicles can be leased from the market for a periodic payment of $500,000. The lessee's incremental borrowing rate on the date of modification is 7%. Account for both the original and the modified lease. Let's account for the original lease. These are the schedules for the calculation of the lease liability, and the right-of-use asset on the commencement date, in addition to the lease amortization schedule. The lease liability at the commencement date is the present value of the periodic payments of 1 million, discounted over a lease term of 8 years with a discount rate of 6%, which is the lessee's incremental borrowing rate on the commencement date. And here, the right-of-use asset includes only the initial measurement of the lease liability on the commencement date. Now, let us account for the lease modification. In this example, we have 2 modifications. The first modification adds 5 vehicles to the 10 vehicles of the original lease, and that modification increases the scope of the lease. The second modification decreases the contractual term of the lease from 8 to 6 years, and that modification decreases the scope of the lease. Let us apply the 2 conditions for both modifications to see how we should account for each modification. For the modification that increases the scope of the lease. First, does the modification increase the scope of the lease by adding a right to use an additional asset? Yes. The modification adds additional 5 vehicles. So, the first condition is satisfied. Second, does the consideration for the lease increase by an amount commensurate with the standalone price for the increase in the scope? As per the modified contract, the consideration for the additional vehicles is $350,000 compared to $500,000, which is the standalone price for these vehicles in the market. This means that the increase in the consideration for the lease is not commensurate with the standalone price for that increase, the case which does not satisfy the second condition, and therefore, we should account for the lease modification that increases the scope of the lease, by adjusting the original lease and not as a separate lease. Let us check the conditions for the modification that decreases the scope of the lease. The first condition, does the modification increase the scope of the lease by adding a right to use an additional asset? Here in the example, the modification does not increase the scope, but decreases it, and therefore, the first condition is not satisfied, and the modification is also accounted for, by adjusting the original lease and not as a separate lease. So, in our example, both modifications shall be accounted for, by adjusting the original lease. This is done by computing the revised lease liability separately for each modification, which is the present value of the revised lease payments for each modification, over the remaining years in the revised lease term, using the revised discount rate at the date of modification. As for the right-of-use asset, the first modification falls under the category of other modifications, and in this case, we need only to adjust the right-of-use asset, with the same figure of the adjustment done to the lease liability. The second modification falls under the decrease in scope category. In this case, we should figure out the effect of the partial termination of the original lease, then figure out whether we have a gain or loss from that termination. This is the lease modification template that we will use in our calculations. Here are the pre-modified balances of the lease liability and the right-of-use asset at the end of year 3, the date of modification. Then we will start first with the modification that decreases the scope of the lease. The effect of the partial termination of the original lease is recognized by calculating the reduction in the carrying amounts of the lease liability and the right-of-use asset for that termination, then figuring out whether we have a gain or loss from the termination. Get the carrying amount of the right-of-use asset just before the modification, at the end of year 3, from here. The remaining years in the original lease term were 5 years from year 4 to year 8. And after the modification, they became 3 years from year 4 to year 6. So, the proportionate balance of the right-of-use asset just after the modification is 2,328,673. And here is the difference, which is the reduction in the right-of-use asset, that reflects the partial termination of the original lease. The reduction in the lease liability is not figured out by calculating the proportionate decrease in the lease liability as we did with the right-of-use asset. This is because the decrease in scope in this example involves a reduction in the lease term, so we can use the present value calculations to figure out the lease liability. There is no need to do the calculations on a proportionate basis as we did with the lease liability in the previous lecture. Get the carrying amount of the lease liability just before the modification date from here. Then determine the lease liability on the modification date, by calculating the present value of the original lease payments, using the original discount rate, over the remaining years in the revised lease term. And we are using the original lease payments and the original discount rate, and not the revised ones, because we want to figure out the effect of the partial termination of the original lease. The original lease payment is 1 million. The original discount rate is 6%. And the remaining years in the revised lease term is 3 years. So, insert the discount periods here starting from year 4. Then the original lease payments. And here are the present value calculations. That's it. This is the lease liability as of the modification date. Insert it here. And the difference is the reduction in the lease liability that reflects the partial termination of the original lease. Now let us figure out whether there is a gain or loss from the partial termination of the original lease. The lease liability decreased by 1,539,352, while the right-of-use asset decreased by a greater figure of 1,552,448, which means that we have a loss from the partial termination of the original lease. So, let us book the journal entry to recognize the partial termination of the original lease. Debit the lease liability by 1,539,352. Credit the right-of-use asset by 1,552,448. And the plug figure is a debit with 13,097, which is the loss resulting from the partial termination of the original lease. Up to this point, the lease liability calculations that we did to figure out the gain or loss resulting from the partial termination of the original lease, were done using the original discount rate of 6%, and ignored the fact that the discount rate at the modification date was 7%, and not 6%. And since that change in the discount rate should not be ignored, we have to record the effect of remeasuring the lease liability using the revised rate of 7% instead of the original rate of 6%. So let us repeat the calculation of the lease liability on the modification date, but this time using the revised discount rate of 7%, and figure out the difference between the two calculations. Insert the revised discount rate of 7% here. And these are the present value factors based on 7% discount rate. And this is the carrying amount of the lease liability based on the revised discount rate. Now, This is the lease liability on the modification date based on the original discount rate. And this is the balance based on the revised discount rate. And this is the difference between the two balances, which means that there is a further reduction in the carrying amount of the lease liability, amounting to £48,695, and that reduction is debited to the lease liability and credited to the right-of-use asset. This entry is booked to record the effect of remeasuring the lease liability using the revised rate of 7%, instead of the original rate of 6%. Now, post the calculations that we did up to this point, to the template of the lease modifications here. The reduction in the lease liability. The reduction in the right-of-use asset. And the loss from the partial termination of the original lease. Then the difference arising from the lease liability recalculations using the revised rate of 7%, instead of the original rate of 6%. Now that we are done with the modification that decreases the scope of the lease, let us move to the modification that increases the scope of the lease. The example stated that the scope of the lease is increased by adding 5 more vehicles, for an additional lease payment of £350,000. So, let us figure out by how much the lease liability and the right-of-use asset should be adjusted, to recognize the increase in the scope of the lease as of the modification date. Insert the discount periods for the remaining lease term. Then the additional lease payments. The present value calculations are done based on the revised rate of 7% on the modification date. And here is the balance of the revised lease liability for the modification that increases the scope of the lease. This is the entry to recognize the increase in the scope of the lease. Post these figures in the template of the lease modifications. And finally, these are the revised balances for the lease liability, and the right-of-use asset for both modifications. Now, let us complete the lease amortization schedule here. Nothing is changed in the first 3 years before the date of modification. Insert the revised balances for both the lease liability and the right-of-use asset, and they are also the beginning balances for year 4. The interest charge starting from year 4 is calculated using the revised rate of 7%. Insert the revised lease payment of £1,350,000, and you already know how to complete the remaining calculations. This is the end of this example and this lecture. Please check the following lecture for a final example about a modification that involves a change in the consideration of the lease.